And hello, everyone. Welcome to another Options Talk. It is May 29th, 6 p.m. Eastern Time. My name is Daniel Sinnick, and I'm greeting you today from our beautiful office here in Montreal, in Canada. And yeah, it is once again time to talk options, and the timing and the moment could not be better because market conditions are very unique right now, and options may just be the right play for you. And why that is, and which option strategies to consider, and how to set them up properly. This is going to be the topic of today's option talk. But before we get started, let me ask you guys a question. I'm calling in from Montreal, from Canada, but where are you calling in from? Who do we have today in the room? Please put your location into the Q&A box of your Zoom window. Who do we have today in the room? Please put your location right there. So into the Q&A box of your Zoom window. Arthur from Germany, from Hamburg. Hey, Arthur. Wie geht's? Alex from Australia. Wow, far away. Gerald from Santa Fe. Hey, Gerald, how's it going? Malcolm from Australia also. Nice. There's another attendee from Australia. Wow, 3 Australians. That's quite unique. Elle from Memphis, southern France. Is that right? Werner from Frankfurt. Hey, Werner, good to see you again. Vicky from Alabama, US. Frank from Lake George, New York. That's actually quite close to Montreal. Beautiful area. We have Florida. We have Anthony from Miami. Hey, Anthony. We have Satish from New Zealand. Florian from Augsburg, Germany. Jerry from Brisbane, Australia. Wow, so many Australians today. Amazing. And we have Bill from Cape Canaveral. Awesome. Well, thank you guys so much for sharing your location. I think we are really all over the world. And I guess for some of you, it's going to be good morning. For some of us, good evening, or perhaps good night if you are in Europe. All right. Now, before we get into it, a quick reminder that this session, of course, is being recorded, and the recording will be sent to you shortly afterwards. And you can rewatch it at this link here, www.tradingindicators.com/alerts. I will also post this link into the chat box. So don't worry if you have to drop off earlier. For some of you, it's going to be very, very late. No problem. You can always rewatch the recording. Also, a quick reminder that trading does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any strategies and trade ideas discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so with this out of the way, let me quickly introduce myself. So I believe we do have quite a few newcomers here today. So my name is Daniel Sinnick. I'm the guy here on the left-hand side. And as mentioned, I'm greeting you today from beautiful Montreal in Canada, which has been our headquarter of tradingindicators.com for almost 10 years now. As you perhaps can tell by the way I talk, I am actually born and raised in Germany, but I moved to Montreal back in the day about 20 years ago for private reasons. And yeah, I haven't looked back since. Now, we at Trading Indicators, we specialize on building innovative trading products. And most notably, as you perhaps can tell from our name, Trading Indicators. So we believe very much in technical analysis. We believe that fundamentals are almost immediately priced in. And by analyzing your price chart from a technical point of view, you will indirectly also take into account fundamental information. We also believe that trading should be simple and can be simple, but you need to know what to look for. And one objective of this webinar today is to point out to you what we are looking for when it comes to trading, and of course, when it comes to trading with options. One last thing before we get into it. If you have any questions, please don't be shy. Put your questions into the Q&A box, and we'll be more than happy to go through all your questions in this presentation. Now, without further ado, let me introduce to you the option professor, our special guest today, Jim Kenny, a true expert in the area of trading options. He's been in the game for, I don't know how long, Jim. How long have you been in the game, my friend, of trading options? Jim, are you there?
You have to
Jim.
unmute yourself
There he
or they
is.
can't hear you, Jim. I've been doing it for decades, and I started out with one of the smartest guys in options, and this was decades ago. And this guy was in there since they were, trading options on a tape. So he really knew options, and I buddied up to him. It was at a big investment company in Newport Beach, and he was really knowledgeable, and he ran a big option operation, and I was his kind of apprentice. So I really learned at the heels of somebody who really knew what he was doing. And then, of course, I got the bug. I mean, I think it's one of the greatest products you can do. There's so many ways to use them, so many ways to enjoy them, and so. You know, I've been doing seminars. I've been telling people all over the country how they work. You got to know the use. You got to know the risk. It's got to be right for you. But after all of that, you can have a lot of fun.
Perfect. Thanks, Jim, for the quick introduction. And of course, today's topic will be all about options. And, it is a complex product. Don't get me wrong. There are many ways to not use them correctly, but there's also many ways to use them correctly. So, and what these ways are and how we look at the market, and more precisely how Jim is looking at the market and how he trades with options, that's going to be the topic of today. But before we start with options, let's start with a general overview of what is going on right now in the markets and perhaps some of the most interesting symbols to watch. So once we do this, and once Jim will go through this market overview, we're going to look at specifically how could we trade today's market using options. And as you will see, this may seem like a very simple question or a statement, but there are many things that you need to consider when using options, because as mentioned before, it is a complex product. But then we're going to move on and look at some of our services that we offer, which are our option alerts. We're going to do a live walkthrough through one of these alerts that we put out a couple of weeks ago and how it could have helped you navigating the options landscape. There's also going to be a special offer later on for all attendees. And of course, there will be time for Q&A. But let's start off with the market overview and what to watch right now in the market. So Jim, please take it away, my friend.
Okay, let me share my screen.
Yep.
Hit
Just
the
gonna
share
enable it.
button,
There we go.
and then we go here, and then show me my chart, and then I go bam, and I go bam, and we are in business. Everybody good?
There we go. Perfect. Go ahead.
Okay. All right, guys. I'll tell you, basically the broad strokes, and then we'll get into the smaller print. Okay. On the S&P, the market obviously peaked up here at around 6,100, and then it went in a big decline. People who got the letter and people who listened to me, I was explaining to them that it was going to have a reversion to the mean. And what does that mean? I'll show you what it means. It means that the S&P has a market up here, and my moving average is down here. And just like it did in 2022, it's going to revert to the mean, which means it's going to go down to 4,000. Up here, it's going to revert to the mean, and that was around 4,800. Also coincided with the high over here. That was my view. That's what happened. I'm very proud of the fact that my view actually worked. Doesn't always work, but it certainly worked that time, didn't it? So that's the big story. Now, what happened? We have shifted from what? Austerity, cuts, tariffs, growth is going to slow, earnings are going to be cut, to what? To there aren't hardly any tariffs. Their cuts are a joke. In fact, even Musk is out there saying the cuts are a joke. In fact, Doge hasn't done anything. And then, of course, growth is not slowing. It's now going because we have a stimulus effect. That budget bill that they're passing is what? It's full of red ink. It's full of spending. It's full of everything that's been going on since 2008 when they started quantitative easing. So nothing's changed. We just have a different uniform on there. We've got a red uniform. We used to have a blue, right? They're still doing the same stuff. They just spend it in a different way. So this is not something you want to step in front of. And so the reason we tanked was because growth was going to be slowing, earnings were going to be cut, the PE ratio was going to be reduced. And just to give you an idea, they were talking about $200 of earnings on the S&P, and they were talking about 20 on the PE ratio, and that gets you to 4,000. That's why we were going down to 4,800, or maybe it was going to be 220 times 22, and that got you to 4,400. So do you understand why it went down? Because people thought earnings were going to come down and the PE ratios were going to come down. Now they don't think like that anymore. Why? Because everything they were thinking doesn't happen. In fact, they have that thing taco now about how, Trump can sometimes change his mind. Well, he changed his mind, and if you're a bullish, thank God for it. Because once it made the turn, because we've now gone from all that talk of tightness, cutting, blah, 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 to what? Red ink, stimulus, spend, deregulation, tax cuts, right? Well, it's a big change of tune. And so there you go. So once we got above 5,200, you get in there. You got above 5,400, you add some more. You get above 5,500, you add some more. Now your number's 5,800. If you can stay above 5,800, it could keep going depending upon how earnings go. If earnings are at 273, which they're saying now, and you are at 22 earnings per P ratio, you're at 6,000. So what if we went to $300 earnings and then you had 22 PE ratio? You're talking 6,600. That's where those guys get those targets from. They're not picking them out of their ear. Those guys have to have math behind it, right? And then, of course, what if you overshoot on earnings and we go to 320 times 22? Well, there you go. There's your 7,000 on the S&P. So, we can all do all of our technical analysis, but at the end of the day, it's going to come down to earnings and how much they are going to pay for those earnings. And the reason it's gone back up is because we went from slower growth, cut your earnings, lower PE ratio, to nothing's changed. Growth is here. Consumers out there spending like a nut. Sure, he has to pay a little bit higher prices, but he's going to do it because he's working. And if he doesn't have the money, a firm, an upstart will give it to him. And the game keeps going. Now, what about now, Jim? Well, now what's your risk? Well, obviously your risk is that, look at these charts. The moving averages are turning up, but they're still under purple. And if you notice, when we had the big run up last year, we're above purple and all the averages are matriculating to the upside and they're all kind of inverted to the upside. That's not the case here. So there's a possibility of a pullback here. And why would we pull back? I'll tell you one reason right off the bat. You already got Musk jumping off the boat about what? About the taxes, about the bill, the big, beautiful bill, the BBB. Well, the problem with the BBB is what? It's full of red ink. And we got tariffs that are going to be 5 times what they were last year, even if they're 10%. So what is that going to do to pricing? Well, you go to the store, they've already hiked the prices. I mean, they haven't hiked them to where I'm not going to buy milk, or I'm going to say, hey, I love turmeric and I love cumin, but I'm not buying it because it's $1 more. No, they haven't done that. They took my workout gloves from 16 to 27. I didn't like that very much. But you know what I mean? People are going to pay. They're going to pay. In fact, Rick Reeder of BlackRock says the economy can take 15% tariffs, no problem, in his view. Okay? So, and he's probably right, as long as they're working. Now, what is going to goof things up then? What's going to goof things up is people jumping off ship in the Senate. And the Senate going, hey, listen, guys, we're not going to give the salt guys 40 grand, and we're not going to do whatever else they're talking about. They're going to cut that thing down. And if you cut the thing down, obviously what? You're going to reduce the enthusiasm of how much stimulus is going to come out of it, and it's going to throw water on the rally. The other thing that could be, problematic is that the earnings estimates may have to, again, be moderated back down, because if the CPI starts printing a lot higher than we're used to, that could be a sticker shock. Now, I'll show you 2 things that I watch that I'd suggest you keep an eye on too, because what I'm doing here today, I'm trying to share with you so that you could obviously have more success. That's the whole idea, isn't it? So here's a couple of things I keep an eye on. Let's look at that VIX. All right. The VIX has been very, very good. Why? Well, let's go back on the 20-year graph, and you can see it's got to, if it stays above 18, it's still going to be capable of going up. Now, I'm going to tell you, if it's between 15 and 20, buy all the stock you can do. Why? Because the market's going up. Why? Because when volatility is quiet between 15 and 20, people feel very comfortable investing. and they do invest. But if it goes to 25 or better, there is a buyer's boycott. And now the market maker is the only guy on the sell side, on the buy side, and everybody wants out. And you know, if the guy who makes markets, Citadel and those kind of guys, if they're the only guy putting up a bid and a ton of selling comes in, the prices go down really sharp. So keep an eye on the VIX. If you see it not being able to get under 18 and stay there, and if you see it above 20 and certainly above 25, get the raincoats out. We're going back down again. Okay, so keep an eye on the VIX. Keep an eye on the VIX. The other thing you got to keep an eye on is the 10-year note. And that's the interest rate picture. Nobody wants the 30-year bond. I mean, they can't give that away. And the reason for it is with these kind of deficits and with this kind of, shall we say, well, we have hedge fund people running the thing. Besant from the Treasury, he's a hedge fund guy. David Sachs, who has got Trump's ear for technology and crypto. He's a venture capitalist. They all started PayPal, and that's how they make their money. And then you know, you've got Lutnick. He used to run Cantor Fitzgerald. These guys are into risk. They're into leverage. That's why they're banging on Powell's door. What are they banging on it for? They want cheap money. And Powell's not a moron. He goes, listen, guys, you're hiking these tariffs. Who knows where they're going to be? I have no idea what prices are going to do. And everyone's working out there, so there could still be huge demand from the public. And you want me to drop rates? They're only at 4. You know, let me give you a tip here. The inflation rate's around 3, and that's without all the tariffs. We go to 4 or 5% inflation, and they catch me with a 2-year note under 4%. You know, you'll be getting gold at $4,500 an ounce. So the bottom line is he knows the risk out there, and he's dealing with people who don't care about the person they borrowed money from. And he is the guy, he's the bank. And the banker's saying, wait a minute, let's get some more data, and then we'll play ball. These other guys want Powell to play it on the come line, like he's gambling in Vegas on the come line. And he's not going to do that because he knows what kind of hassle he's going to have, just like he had when the inflation went nuts. Of course, they did print $9 trillion, which caused the inflation to come back. But that's why the 10-year note won't come down. And that's why I am vigilant on that the trend is up for interest rates. And as you can see on this graph, until you hear the yield under 390. If the yield goes under 390, you'll get all the cuts you want because you can see there's nothing underneath it. Okay, so that's the story. And the blue line has been a friend to me because rather than getting bullish on bonds when it goes down to 350, I got bearish on bonds. And when it goes down to 388 and people are bullish on bonds, I'm saying get bearish on bonds because that blue line is very powerful.
And Jim,
Yep.
real quick, because
Sure.
we do have quite a few newcomers here who hear you talk perhaps for the first time. Quickly
Yep.
explain what these moving averages are on your chart.
Yeah, well, they're my moving averages, and they're no magic, but they work for me, and I interpret them a certain way. Because really, that's what investing is all about. Everyone's got the data. Now, how do you interpret it? That separates the art from the science, right? So what do I got up here? I got a 12, I got a 24, I got a 36, I got a 120, and I got a 250.
Yeah, and you can see the numbers right next to the colors on top.
Yep,
so
and they're
red
called
one is
simple.
the 12.
They're simple moving averages. Now, I'm not saying these are the best ones. I'm not saying they are the only ones. I'm saying they're mine, and I suggest you come up with something that you trust, because when you trust it, then you have a discipline, and when you have a discipline, even when you're wrong sometimes, unless your discipline is extremely flawed, the mathematics could work out fairly well as far as wins and losses are concerned. Now, let me tell you basically real quick what I use them for. The red line tells me the trend is changing. Blue and green tell me we're going to go on a long way or we're not going to go on a long way. Purple and gold are reversion to the mean levels, or they're significant trend change levels. So basically, that's what I use them for. And they've been very, very good to me. And that's why I use them. So that's the story with them. They're obviously different. And I always look at things at different time frames, because you'll be shocked how a different time frame may either confirm your suspicion on something, or it can prove you wrong and you can avoid a problem, simply because a different time frame may be telling you substantially different information. So it's always nice to have all of the time frames, giving you the same idea. But that's not always the case. But when it is, that's real powerful. Well, let's put it this way, this thing has been rising for a long time. This is interest rates going up. So you can see if we break above 475 and 5%, because inflation starts coming up a lot higher and the consumer keeps spending on retail sales. So now you got a consumer spending and higher prices, and these things break above 5, that could be problems for the valuation of stock, because interest rates is a big factor on how they value stocks. And that's one of the reasons the stock market went nuts when we had zero interest rates, because the valuations could be very high because there was no interest drag on the model. Okay, so again, those are the things, and I think I just gave you a pretty good idea on what I'm saying about the stock market right now. Have to be concerned if we break 5,800 for sure, and if the Senate starts really taking a machete to this thing and changes the talk. Other than that, you cannot fight the tape and you cannot fight the government. And if they're going to stimulate and they're going to really red ink it here, and then they're ever going to get Powell to drop the rates, I mean, earnings could really, really take off. Real quick, let's just I'm going to take a little quick at NVIDIA here, because, something that I talked about. It's a little bit of a sidebar, but I think it would be nice for you to take a look at it. Because before it came out, I said 140 area is going to be where most people think it might stop. It's supposed to have no more than an 8% pop in it. Well, that was about 142, which is what we saw today, right? And as you can see,
of course, NVIDIA, Jim, just for a bit of context, had earnings, I believe, yesterday, or when was it?
And they did. And yeah. I'll tell you what I zeroed in on, which not many people did. And that's why I would be selling that thing all day long at 142. And I could be wrong, but I could be right. But there's, between the specialists, meaning the market makers, had a lot of call options at 140 area. And that was supposed to be putting a cap on this thing. And that was about an 8% jump, which would have been the 142 neighborhood. And the fact that their margins went down to 60% from 76%. Now, they blamed it on this charge from China of 4.5 billion, but then they said the charge from China next quarter is going to be 8 billion, which tells me that that's going to hurt their margins again, possibly. The other thing that could hurt the stocks a little bit is the enthusiasm on a short run on a lot of things that may be longer term in horizon. Let me just give you a couple little tips here. This is the nuclear stocks, which had a huge jump because supposedly we're going to have all systems go for nuclear. But look at this thing, Constellation Energy. That's a big run already, right? I'll give you another one. This is called Cameco or Cameco, or however you want to pronounce it. It's a Canadian firm. And you can see here that it also spiked up. Again, this is plenty of enthusiasm about nuclear. And then they're going to wake up and they're going to say, it takes 7 years to make a nuclear plant. And, there's other factors going on here that makes this not an overnight sensation. And that can cool things off. The other thing that has been very big here was the quantum. And me and Daniel did a show on this thing about 2-3 months ago. All these stocks I'm showing you were right at the seminar near the lows. Not a bad seminar to go to. And I'll just rattle off a few of them for you. D-Wave, I mean, right before, I think the day we did the seminar here, I think it was right here. That's the day, May something. And then look at this. Again, though, quantum is a longer term horizon. So that's why you can't be buying things after they happen. But that was one we had on the list. We also had quantum itself, which is QUBT. So that was a fabulous seminar, and I'm very happy to say that we had some good ideas that came out of this thing. As you can see, this thing may even actually have a little bit more to run. And then you've got the other one is IONQ. But this is just giving you an example of like how some things may take longer than you think. And that's why you have to be somewhat careful about it. Again, this was a real big explosion to the upside since May as well. Against 25 to 50, that's not a bad deal. The other thing is crypto. This is something that we have been talking about here for quite a long time. And people probably want to take a look at it. So let me take a quick look here. This is a chart on Bitcoin. I'll tell you exactly what I've been saying in the weekly updates. You know, okay, you go to, I went to the 5-year graph because it smooths out everything. Okay, you see down here, this is where we first got very excited about it because this was what? Reversion to the mean, a rising blue line, it's going to go. And so it did go. Then it's up here, we have a gap. The idea was to come back and fill the gap and revert to the mean. That's exactly what happened. Then we said, load the wagon. It's going to have another run. It may go to 150 grand because that's what a guy like Tom Lee is talking about because of the halving that happened last year. Well, we've already just made a new high, but again, it also could pull back. You got to take advantage of things when they're on sale. If you don't, you're going to end up not happy generally. Now, one of the stocks we think and have thought that is something to focus on, there's two really that are the leaders here. And this is the guy who is borrowing money and buying Bitcoin. But again, down here at 150, very excited about it. Great job. And then we pull back to the mean. Good, very excited about it. Great job. Now it's pulling back. If it can hold the 330, 320, 340 area, we're still in business. Again, the blue line is not going to turn down overnight. So as long as I can keep that rising, even penetrations are not going to worry me. When it goes down, it'll worry me. The other one is Coinbase. And that one just really recently just went up because of the fact that they also joined one of the big indexes, which means people have to buy them who mirror the index. But again, this one's been a laggard as well. But when it reverts to the mean, you remember I told you the gold and the blue and the purple lines? This is the reversion. So when it goes and reverts, that's when my antenna goes up. And that's when on the alerts on the weekend, I put them together and I'll say, hey, listen, guys, Coinbase has had a pullback. This is where you want to focus. And that's how I update things on the alerts as well. So those are the two. Now there's three that are small guys that have resistance, but if they break resistance, they're going to be pretty sharp. So let's take a look at the three. Look at that. You can see if you can get above that resistance there, let's call it 17 bucks. There's nothing above it. Look at over here on the 1 year. See, if you can get above that 17, 18. So I would keep an eye on this baby because if it gets above there, that is open field running. Next one up is HUT. People always say, how do you keep track of all these things? I don't know. I like them. You know, if you like to do something, it's not work, right? We get above 18 here, and that thing's going to get going, I think, as well. And then the last one here is Riot. Riot. I like that name, Riot. Riot. Okay, on Riot, you are looking at, again, you got to get through 10. And then you're home free. So keep an eye on it because if we're going to 150 on Bitcoin, if we're going to go to 250, I mean, this guy, Tom Lee, he's no dummy. I'm sure he'd be the first one to say he's not guaranteeing anything, but you know, and you know what he's saying is basically that we're getting more people, more. We just had a big convention here in Vegas, and you know, David Sachs was there, the vice president was there, the Trump twins were there. What do you call it? Everybody was there. Okay, and so Michael Saylor was here from Strategy, and these guys are saying the adoption is getting bigger and bigger and bigger and bigger. And people with lots of money, like Blackstone, you know, the big companies are now suggesting a diversification into it. Well, you know, this is only a $2 trillion market. If you got 5% or 10% of world assets to come into this thing, you know, it could fly. And I'll tell you the other thing is treasury stock being used to buy. What that treasury stock, what does that mean? Companies have cash. You know how much cash Apple has, Meta has? They have tons of cash. If they took some of their cash and bought Bitcoin with it, that would be another extremely good driver. And then, of course, the banking industry is being reconstructed because you can transfer money 24/7 and 7 days a week. And so, you know, that's a big advantage to some people. So, you know, they're getting the rules and regs down. They got the stable coins coming in that are extremely popular. In fact, stable coins were in the top 10 buyers of US treasuries last year. So this is a freight train. but it's going to be a freight train that comes and goes. In other words, not comes and goes, but you know what I mean, ebbs and flows. It has big rallies, then has pullback, then has big rallies, that kind of thing. So obviously, reversions to the mean are your entry levels at, if you want ultimate, shall we say, more advantageous levels.
Yeah.
So that's pretty much that. Yeah.
That's great. So let me quickly take the screen back, Jim,
Sure.
because now, of course, we want to talk about so now let's say you have an idea in mind. Let's say, your play would be perhaps, okay, I have a stock which could be exploding in the future, perhaps the quantum stock, which, we pointed out a couple of weeks or months ago. So we have this idea of, hey, this stock might really fly, but how would we set up a trade for this? Because there's so many options, and this is not a play on word because, options is also a financial product. But there's so many ways how a trade could be set up. It could be outright, or it could be with options, for example. Now, let me give you some examples of where the complexity comes in, because this is really where the rubber hits the road, because you need to be smart about it, how to carefully select the best trade for you. So, in fact, there are, and this is of course an exaggeration, but there are a lot of ways how you can set up a trade with stock options. You can place outright calls or puts, perhaps the easiest strategy out there. So outright calls, of course, if you're thinking this stock is going to go up, or outright puts if it's going to go down. You can set up strangles or straddles, a completely different strategy, banking on the fact that, hey, maybe I'm not sure about the direction where this thing is going to go, but I'm fairly certain about that it's going to move from here on. And for these kind of scenarios, a strangle or straddle could be the ideal way to set it up. Banking on the fact that if it goes up enough or goes down enough, I will be making some money. You could also be looking at put writing. Perhaps you eventually want to establish an outright stock position for let's say Apple or Tesla, whatever you're interested in, or Nvidia. Maybe put writing is the right way to do it to get this stock at a discount that way through an option strategy. You can set up debit spreads to reduce your price, what you have to pay for your options, or a credit spread even. So many different ways to do it. And some will be the better way to do, and some will not be so good. But how do we choose? How do we find the ones which are right for what we have in mind? And let me just add on this just a little bit, and Jim is going to come back on again. Once, let's say, we know what we want to do. Let's say you want to do an outright call or perhaps an outright strangle. What do we have to consider then? Well, and there's so many questions we should ask ourselves. And perhaps the easiest one is the first one here. Where is the future price going to be from now on? Maybe in 3 months from now, or in 6 months from now, or perhaps 12 months from now. Because you need to have an outlook. Hey, we think that price might go to this level in a certain period of time. And this is almost the easiest question to answer. It gets more complicated. What about this? How do we choose the right strike prices and the expiration if we want to play this with options? That's also an easy question to answer. For this, you need experience, and it needs to be well thought out. And perhaps where it really matters is, how do we know whether an option is currently overpriced or perhaps underpriced? Because, trading of options is just like trading of stocks. We want to buy cheap and we want to sell at a higher price. But how do we know whether an options offer is currently cheap or underpriced, or whether it's perhaps overpriced? How do we know what the expectation of volatility is right now? So all these things need to be answered and addressed. And Jim, I'd like you to chime in on this one. How do you look at these things, and how do you select your option strategy, or how do you answer any of these questions? What is your take on this?
Well, a lot of it has to do with what your objective is. So obviously, like you were saying, if Tesla goes down to 250 or something and you really think it's a good place to buy, but you want an edge. Well, what you might do is sell an out of the money put underneath 200, grab that premium and sit there and see if you get put stock, or take that put premium and then go buy a call with it. Your break even changes to just the strike price, but your call option, when it goes back to 360 like it just did, can make you a heck of a lot of money. And you really used Peter's money to pay Paul. So that's run right off the bat that when markets are down on high quality companies that you really like, it's not a bad strategy. It hedges your upside risk because people that are trying to buy Tesla at $200 ain't happening anymore. And it also gives you a price advantage from the standpoint of you're agreeing to buy it substantially lower. I can show you an example of that in a second. And I'd also like to show you why I like Strangle so much. All these strategies I'm extremely familiar with. So if you're trading them now, obviously, and you're a subscriber, you can call me up and we can have a talk and you show me what strategies you're doing, and then I can share my opinion on how I would do it. Maybe it'll be a good opinion, I can't say, but it'll be the best opinion I can come up with the knowledge and experience that I have. So if you'd want me to share the screen a little bit, maybe I could go through some of the strategies and how I figure out when an option might be a good deal. Can I do that?
Jim, I was muted. Yes, I just wanted to say one thing
Okay, sure.
before you do this.
Sure.
Keep in mind that a lot of stuff or a lot of strategies that we've been focusing on are on how to potentially grow a small account into a big account. So we are looking out for what could earn us a really big payday in the future. These are the strategies that we've been focusing on so far, and how these can be set up either with strangles or perhaps even with outright calls or spreads. Jim is going to show you now. So Jim, please take it away and share your screen.
Yeah, one comment before we leave that subject is that, again, this is just my opinion. People have all kinds of money. They have money in treasury bills, they have money in real estate, they have some money in some retirement 401k, and then they have a thing called risk capital. And with the risk capital, you're trying to make an aggressive return. And if you keep gravitating to strategies that buy and sell options at the same time, you're like credit spreads. I run into a lot of people that are trying to make they're taking awful lot of risk on, in my view, and they only have a little peanut to make. I just went to a seminar where they were talking about this butterfly strategy, and the credit was 50 cents. And I was getting a headache trying to follow all the legs they were putting on. They had more legs than an octopus. And I said to myself, I'm getting a headache. And how much is the potential gain here? 54 cents? I can't even put more cheese on my cheeseburger with that. So, I'm looking for things that have limited risk and a very substantial gain potential. And then I'm looking to use positioning, portfolio management, and risk management to make sure I can do it for a very long time, because sooner or later the odds kick in. I used to sell options for a living, and I know when you get in trouble selling options, when the premiums are low and volatility expands. And so what I do each and every week is I go and I look, and you'll see from some of the examples, I'm not prejudiced. Any stock anywhere that has the proper setup can come and join my club anytime. Not all of them work, but a lot of them work, and a lot of them work in a big way. So that's basically what we're trying to do here. But if you're doing the other strategies and you have a subscribership and you have a question, I don't consider myself a bad resource to run your questions by, because I give you a very, I think, clear explanation of my views on them. And my views are based on significant experience. Okay, so let me go and share the screen and show you some stuff here on how I look at things. Now, there is so much information out there, guys. And believe me, my antenna's up on all of it. I got the Bloomberg going. I got the fast money going. I got all the internet stuff that keeps coming up. And, I subscribe to a number of different things just to get, ideas, because I can't follow every single stock, but I can follow them in 2 seconds or less if I get the name. And so basically, I'll give you, for instance, here, this is Estee Lauder. I like to look at what some people are doing who have a lot of, history to them that are pretty sharp. The Stanley Druckenmillers, the David Teppers of the world, the Stephen Cohens, the guys like, this is Michael Burry, and then maybe Peter Thiel, guys who, pretty sharp guys. And so they have these 13F filings with some of them, and they tell you what they actually have done. That doesn't mean, it's a timing tool, but it's nice to know what's in their inventory. And Michael Burry, when he came out with his last thing, he had nothing going except Estee Lauder. And this came out just like very recently. And you can see the stock was trading at like 55. And you can see that it was turning up pretty well. So this is an example of, when you start seeing it turn up, you might be able to catch something here and then follow the trend. Because if it gets through purple, it can go to 80. Now, 55 to 80, there's going to be a couple of call options that are going to be worthwhile to look at. Now, I did mention Peter Thiel, and I looked up to some of the companies that they say, I can't guarantee this information, but that he has interest in. So I looked at them and I said, you know what? Some of these things don't look so bad. I'm going to start looking at possibly doing maybe something with them. The first one is called Affirm. And we had this on the alerts at 25 bucks. So I'm no stranger to this thing. But you can see we had it like back here, and then it went like there. But now look at it. It's right into this thing here. And see, this is when the options might be reasonably priced because the market has come down to the mean. The lines are kind of intersecting here, and the RSI is trying to turn up. So let's go take a look at the calls. And let's say it's at 52. And where could we think it might go? See, you have to have an idea where you're going and where you are. So let me go back and get an idea of what a target might be on this thing if it got going. Okay. If it can get through here, right? The idea is, we could maybe go from 30 to 80 is a $50 move. If you went 60% of that, you might go up towards 70. So let's just say we thought it might go to 70. Is there anything worthwhile there? Let's go to July 18th. Why July 18th? Because we're going to have a lot of information. We're going to have the pause done by July 18th, right? We're going to have a lot of the Senate will be done by July 18th, maybe. So if we look here and I see the $60 calls are going for $2.11 last trade. And let's say the stock went on a $20 move. Well, what are the $40 calls going for? They're going for 12. So if this thing went up fast, either 10 bucks would take me from 60 to where the 50s are, which is 6. Nothing wrong with 2 to 6. Or if it really spiked up, like some of them can do sometimes, right? It can really take off. This kind of happens generally after earnings or something else. But that's how I would price out an idea. And you can see I'm not the only guy thinking about it. This has open interest of almost 1,600 contracts and 200 cars traded on Friday. So not too shabby. Okay, so that gives you an idea on there. Let me show you a couple more here because he had a couple of other ones that look kind of nice. And then I'm going to show you a couple that I came up with myself. Okay, so here, this one is called ASAN. They're into software. And, anytime you hear software and it becomes popular, there's profits there because the margin of profit on software seems to be pretty darn good. And this thing is banging on the door here. Now, if it can get through here, obviously it has a lot of potential on the upside. So I'm looking at this. This is just something I saw today that I'm having on my radar. You ever heard that? You put things on your radar. You don't want to forget about them because this thing, if it breaks above the purple line, is going to fly. Because you can see it could not do it here, but it's banging on the door again. So now let's look at the calls. Let's say you think it's going up towards 23 or something like that. What are the 20 calls going for? We go out to July because we want to be in there for that time frame. We see the $20 calls are a buck, right? You can see if it jumps up $2 fast, you're going to be at 2. And if it goes up, if it goes up $5, you're going to be at 4. That's a 400% jump if we could jump up fast. Okay, so if it breaks out, that's the kind of volatility I can get. That makes it interesting. Let's go take a look at another one that he owns here, or they say he owns, which is called Airbnb. I mean, if people are going to travel this summer, they're going to go to use their Airbnbs, right? Maybe. Let's find out. Okay, let's look at the chart first so we can get an idea. All right, Airbnb. Now, I like this one a little bit because it's in a traffic jam. I call it a traffic jam. You see, it's a traffic jam between 125 and 130. You got all these averages and a little bit above there. So if you told me if we went out to July 18th, do I think this thing will still be in this range July 18th? And I would say no. Now, the blue line is turning up. I find that to be very constructive. So as long as we hold 125, and if we were to take out 135, I think this thing could accelerate a bit to the upside, and your RSI is right at 50. So if we took out 135 and the RSI starts going up, I don't think 140 would hold it, because I think the news would probably be that people are traveling and they're using Airbnb. So let's see if there's anything happening here on the call side that would make any sense. Thinking it might go up towards 150. We go back out to our July month. And you will notice that, say, where are we at? A little bit out of the money we go. So if you went with the 140s for $2, right? 222. If you got a $10 move, it would go to 590 if it happened fast. And then, of course, if it had a $15 move, you'd be at 8 and change. And if it really went from 120, if it really went, yeah, so a $20 move would take you all the way up to 12. So this could really explode in price if it takes off. And you can see there's a few people in there thinking the same thing, because the open interest is pretty good.
Yeah, and just Jim, just stay on this just for 1 second, because
Sure.
I think it's worthwhile explaining how you approximate what the option's going to be worth if a certain price move happens, because you kind of do it backwards. You look at what would be your strike price, and then you look back. Okay, if let's say for my strike price is 140 and the stock moves $20, how do you approximate the price difference? You actually go backwards in the strike price and see what is the price $20 cheaper. Let's see if your expected move is $20, and you
Yeah.
compare
And
the
this,
two prices.
exactly, exactly. Otherwise, I'd have no idea where it's going to go. And sometimes these options are all priced the same. And if they're priced the same, then I don't like it at all, because here, this could still stay out of the money a little bit and you'd still be able to make money. In other words, if we're at 128 and it goes up to 138, it's still $2 out of the money, but my option's going to go from 2 to 6 or 2 to 7 or even more, because don't forget, implied volatility is going to increase as it gets going. So when I talk about what they could go to, it also means it's going to happen fairly soon, not on the last day. Also, you shouldn't be in there the last day. That's why I try to, we'll get into the report. When I do a strangle on something, I'm not going to hold it to the bitter end generally, unless there's a darn good reason, because after a certain period of time, if it's not happening, I want to cut and run to preserve what I've got, and then basically, go on to something else, because there's plenty of ideas out there. So you don't want to let your capital get dinged too much with something that's not working. One last thing is what some people don't understand also is, let me explain. If I buy the 140 call at 222 and it jumped up $10, okay? And I could sell, you see this price here, 150? If it jumped up $10, it would be going for 222 if it happened fast. So if I'm long the 140 calls, right? I'm long the 140 calls and I pay 222 and it jumps $10. Now it's at 138. It's out of the money. I could sell the call and take the money and make $4, maybe $5, or I could sell the 150 calls, which would be going for 222. And if I sell the 150 calls for 222, it gives me all my money back from the 140s for 222, and I have a free look at a $10 spread, which means I could make $1,000 and I have no cash out of my pocket at risk. Because if the market were to go down, I'm going to keep the 222 that I sold the 150 call for, which pays for my original cost on the 140s. So that's called legging into a bull call spread, if you want to use textbook on it. But all you're doing is you're selling an out of the money call, grabbing that cash, putting it into the account to offset your risk, and now you're skipping down the street going, I'm either going to make a grand or I don't lose a penny. That sound like a good deal to you? It sounds like a good deal to me. So once you get involved in a call or a put, and you can sell an out of the money strike price for what you paid for the one you got, then you have an ability to get involved in a riskless trade from the standpoint of net cost. And that's not bad. And if that's confusing to you, when you are a subscriber and we have a coaching session, we can walk through that much slower so you can get it, so it can become second nature, which obviously it is to me.
Yeah,
So,
on that note, real quick, we also have a masterclass recorded where we go through all these strategies in detail, and we're gonna let you know in a bit how you can get access to this masterclass as well.
and so anyway, I showed you a couple off of Mr. Thiel's holdings there, and I would like to also show a couple that I've come up with here this week, and I thought they were pretty inexpensive. Again, that's what I like. Inexpensive, that's going to get very expensive, right? So let's look at BBAI. And I identified this last week before it moved. Now, these guys are supposedly kind of in the same kind of business as who? As Palantir. That sounds pretty good to me because I bought Palantir at 31 bucks and that was before it did all its thing. So I'm very happy with that. And I can see that the government doesn't mind paying people money if they have software that helps them. So this thing here was very inexpensive and I thought the chart looked pretty good. So I'm going to get back onto the chart here and show you what it looked like. And it's BBAI. Big Bear AI. They have contracts with the government and many other people too. Now that thing looks like it's building, building, and building. Now, I don't know if it's going to break out or not, but the $2.50 calls were going for like $1 and change going out till July 18. So if in fact this thing can go, it's already in the money, right? And it was this week it was at 450, so it was in the money by $2, and the premium was only like $1 and change. But if this thing can get going further, and this chart tells me it might be able to do it. You see this RSI looks like it's trying to make a thing. And so if it could pop and go up to 8 or 850, the $1.50 is going to go to $6.50. I don't know if that's going to happen or not, but I do know one thing. It's had its reversion to the mean, so that looks like it's over. The blue line's rising. That's powerful. Green's above blue. That's powerful. And the red looks like it wants to turn up. And it's only what? May still. So by July 18th, it's going to be a while from now. And I'm just thinking that it could possibly have a good pop if it does. Another one was something that had to do with a platinum story. Do you know in the first quarter up in China, they bought more platinum than they bought in a long, long time. And they're putting a squeeze on the price. Let me show you what the squeeze looks like. And this is a fairly thin market. Now, why are they doing it? Because the jewelry business up in China is what? Is slowing down because gold is so expensive. So they're going to the alternative metal. And this is what it looked like after that report came out. So there you go. And then you have it on the 5-year graph. There you go. And there you have it on the 20-year graph. Now, the 20-year graph looks to me like it could keep going. That RSI does not look bad. If it's going to keep going between now and the next 2 months, there's a couple of companies that I thought looked good. One had options, one didn't. So there were some customers who talked to me and he said, Jim, what do you think looks good? I said, well, this is $6 a share and I think it looks outstanding. And I'll show you why I thought it looked outstanding. You see, that is called a traffic jam. And with the news that they had, I thought it would pop. So what I did is I bought the stock. But when it popped, I took my gain. So I took a couple of bucks out of it, let's say, right? And then I went to something that has options. Here's something that has options. So I took from Peter. So I got found money, right? I got some profits over there. These guys don't have options. I want limited risk and leverage. So I go over to SBSW, which I think is the largest producer of platinum in the world. And I see the chart looks pretty reasonable. You see, on the 5-year, it looks like it's, it could go up towards gold, maybe, right? And on the 20-year, it's running into some resistance here, but if it breaks, it got some more to go. And the RSI is rising. And this guy had a nice big move. But when you look at the longer term graph and put in perspective, this thing used to be an awful lot higher. So could we have a possible run? Yeah. Well, I looked at these options here and I said, you know what? I got some found money from that other thing, right? So why don't we get some leverage and have some fun here? So I go over to the $6 calls and I start buying them at 40 cents. 40 cents. So that means for every 100 shares, I got to put up 40 bucks. So if I buy 10 of them, I got to put up 400 bucks. That's 1,000 shares. If I want to buy, 100 of them, I got to put up, whatever. So the bottom line is that I can get a good sized position here for not much money. And if it goes up to 9, these things are going to go to 300. If they go to 8, I'll get 200. So either way, there could be some very good potential here. It's got good open interest here. And I don't know what's going to happen. But if the Chinese keep buying at a brisk pace in the next 2 months, and in the article I read, it's supposed to get a good bid for the next 2 months, I thought it was a good chance. Because again, the risk out of pocket is very low. It's getting more now than it was. But I think it was something that I thought was right up the alley of looking for something that doesn't cost much, that had a little bit of a story behind it, and it might be a very good situation looking forward.
Yeah. Great.
And so, yeah, like I say, and every week we always go over. So let me just throw some big guys out there because I'm not only into these other things like this. I do stuff on the big ones all the time, like Google. And Google is at a very big point here. So you're going to have a good opportunity one way or the other on Google. I'll show you why. You see, it's running into purple. It's either going to bust through purple and go after that gap, or it's going to fail from here and pull back maybe as low as 165, 160. So I think it's at a critical joint. To give you an idea how the options are priced. And some of you guys like to do like the real short-term trading, and I do it sometimes too. I do all types of trading. So say you thought next week the market was going to be volatile on it, right? Well, let's do a strangle here, and I'll show you what a strangle looks like. You're at 173. So what's the 175 calls going for? $2. Okay. Well, just look if it went up $10, what those calls would do. Look what the 165s are going for. Not bad. Okay, so we know we got $2 on the 175 calls, right? You got the right to buy at 175 until next Friday. This is a short-term gamble, no doubt about it. Now let's go over to the puts. And obviously we'd look at something like the 170s for 161. So you're into the thing for $361 total price, right? And what do you got? You got the right to buy at 175. You got the right to sell it at 170. And you're looking for all hell to break loose between now and next Friday. If that happens, let's just see if you went down $10 here. The 170 puts, if we went in the money, look, $10, $7, $8. Don't forget, you're only at risk for 361. And then basically on the call side, we figured out what? Up $10 would take you up towards 8 or 9. So there's plenty of action there, and 361, doesn't seem too bad if it's going to move. And then, of course, you've got to be very what? You've got to be very hyper to keep a close eye on it. And if it, then you trade it from there. You might get rid of one side, keep the other, as you get more information. And where would I get more information? Since I'm trading short term, I'm not going to look at the 20-year graph anymore. I'll look at my 2-hour graph. And of course, right now, I got RSI up here at 70, and I got the RSI here at 61, and now the RSI is at 54. So if it breaks under 170, I probably, or even much lower than it is now, I would probably ditch the call. Likewise, if it can't get underneath the blue line, which is right there at 171 ballpark, and it starts taking off, you see right now it's on the defensive, but if it got above 174, it wouldn't be. So obviously if it starts taking off, you could ditch the put. but you got it strangled until you don't have it strangled, and your total risk is 361. And you could see by the premiums that if it got volatile, there's action to be had there. A couple of other big ones here would be Apple. Apple's got a lot of bad press, but all they have to do is announce they're going to put something new in the phone, and the next thing you know, it could go the other way. And if you look at the graph on it, it looks to me like, again, it could start really gapping to the downside if it takes out 195, but it could also go back to 225. So you've got a possibility that Apple could be quite volatile. And look, it's holding on for dear life. So if it breaks under here, 195, look, boom, there's the trap door. And that red line's not a joke. So let's take a look at Apple if you want to do a short-term game, because I know you guys sometimes are doing day trading and, all that kind of stuff. Well, it's not illegal to do short-term options either. So let's you go out to next Friday and let's see what's cooking. You're at $200 a share. So if you went to, say, 205s for $1.50, and you went to 195s, for $1.64, you're into the thing for $3, right? 310, 315, whatever. Yeah, 314. Maximum risk. Let's say we go $10 up or down. Let's see what happens. We go up $10. Where's it? 195s. They're trading 6, 7. And that's not even counting if it happened on Monday or Tuesday, if the volatility was big. Then on the downside, you're going to have the 195s. You go down $10. Again, you're back to 6 or so. And you know how you make a lot of money on some of these things sometimes is if, in fact, it really does break a trap door and it accelerates to the downside. And what trap door are you talking about? I'm talking about the purple line there. And I'm talking about what's that line come in at? 197.95. So you break under 197, you break under 197 and then 195, you could get an acceleration to the downside. You see the RSI is trying to make a decision as well. It's right at what? 42. You know what I say about 42? It's at the bottom. You're not going to get an acceleration to the downside unless it breaks 42. So if we broke 197 and we broke what? 195, you could get this thing down underneath 40, and that would cause an acceleration in my view. Where's your RSI here? Again, 40s. You want it under 40 if you're going to get an acceleration, and you could get that. Believe me, we take out 195, this thing I think will break 40. And if that happens, that opens the door to all this neighborhood down here. So you know how you make a home run on some of these things? You do the 195 puts and the 205 calls, you put up your lousy $300, and all of a sudden this thing happens over here, right? This thing happens here. And if that happens here and you go back down to 180, you're talking $1,500 on 300. And that's where the gains on options can come if you're right. So there's a couple of examples there. And was there anything else that I was supposed to cover? Or I think
that's great, Jim. Let me take over the screen, and I want to bring it back to a couple of things that we just discussed. So first off, maybe I hope it became clear that option trading can be quite complex and honestly actually also quite overwhelming because there's so many things that you need to look at to get your option strategy right. Now, Jim gave you some examples of what he looks at, and he's been in the game for so long that there's so many things he considers at the same time, but it can be quite overwhelming, even for the most seasoned option trader. Now, what if there was something which could get you these option ideas that you saw right now? Because it takes quite some time to find these and to find options which actually, or stocks which are just right now, where the options are priced just the way we want it to be priced, where the upside potential is just what we want it to be. What if you could get these ideas delivered to you on a silver platter? Well, we have come up with a service which we offer to our clients, which we call the Options Triple Play Alerts, which basically is a letter which you get every Sunday like clockwork to your inbox, which will detail to you all the option ideas which are interesting right now, which you can take advantage of. But not like this, not just that, you'll also see exactly what you need to do, how you need to set up your options trade in terms of expiration, strike prices, which legs to play, and so forth. And how this works, I'm going to show you right now. And if you're interested, it's at tradingindicators.com/alerts. I'm going to get to this in just a bit. Now, let me switch over to an alert that we sent out a couple of weeks ago. Just give me 1 second. Just find it here on my other screen. There we go. And there we go. All right. So I'm going to drag this in just a second. There we go. Okay, this is my browser window. And just to get you an idea what this alert looks like, it's basically an email which will come to your inbox every Sunday afternoon. Now, there's also an option to download and print out a PDF, but the email basically looks as follows. And let me actually open up the PDF because it's a bit easier to read, but everything, what you see in the PDF is also available in the email. So I'm going to open it up here. And this will open up in my PDF viewer. And basically, you get a market report written by the option professor, which contains a lot of useful information. So let me give you some ideas, and Jim, maybe also chime in on this. So we're going to start it off in every single alert with an introduction where we review what has happened right now in the market, what has transpired during the last week, to give you some context of, hey, where are we right now, and perhaps what may happen next in the market. This is all the context that you should know. And this exceeds just having options, the option space. This covers all kinds of aspects in the market.
And the main thing is there's questions that I'm asking up there that you should be asking yourself each and every week. So this week we were having a free fall in the VIX, and we were having a data lag, meaning we were getting data, but it was not included with the tariff information. We were looking at where the Fed put was, and if you look where I said the Fed put, I mean the Trump put, I said it was at 4,800, and that was pretty accurate because that's exactly where the low is. So I had the support zone 5,100 to 4,800, and as far as the Trump put, I thought the Trump put was at 4,800. And that came to pass as well. So this information would have been helpful to you no matter what trading you were doing.
Yeah, so this is a good overview of what has happened in the market. But then we move on towards the next section, which is our level 1 alerts. Basically, a list of stocks identified by Jim, the option professor, which could be of interest for a strangle setup. And just as a reminder, a strangle is an options play where you are betting on the fact that the stock price is going to move. It's not gonna stay stationary where it is right now. It's gonna move. It can move to the upside or the downside. Whatever it is, as long as it moves substantially, you will benefit from the setup. And for example, what you see here is you see which stock is concerned, what is the strategy. In this case, it's a strangle. Which expiration you should use for your options chain, where to buy your call and your put. This is an options play, and we can detail this in a bit, where you would buy a call option and a put option at different strike prices for the same expiration. Yeah, you see the cost, where it would approximately cost you, and that's basically all you need to know. So you can use this information and enter this into your broker platform and purchase exactly this trade idea. Of course, we always recommend to do a bit of due diligence, to look at the chart, make sure you also like the price chart, you like the setup. And if you're comfortable, well, then you can follow suit this trade idea. And you can see here there are many different options you can choose from for these strangles. All of these are handpicked by the option professor. I can tell you this is a whole lot of work he puts in there every single weekend to identify strangle ideas, which first of all have a good potential to move before expiration, and where the options are relatively lowly priced. Both of these things, of course, need to come together. So, and you can also see which sector this strangle plays in, because diversification, it's an important thing for trading, but also for options trading. So you don't want to over leverage yourself in one sector. This is why we have included the sector in which the stock plays in as well. All right, so these are all these strangles. There are probably 20 or 25 of them, and then we move on. Then we move on to our level 2 alerts, which are trade ideas for the major indices, the S&P 500, both the cash market and the ETF, the Nasdaq, and also the Russell. showing you what are key levels that we're looking at and where do we think, or where do Jim thinks prices may go next, where is the next key resistance level and the next support level. All right. And then as our level 3 alerts, we move on to the longer term plays. These are the kind of the home run trades that we're aiming for. And they're more speculative. They typically have an expiration date, which is further out because you want to give this move a bit longer to play out. The strangle ideas in the beginning, they have expiration dates which are fairly nearby. But these level 3 alerts, they have expirations which are further out, allowing this trade to develop longer over time. And typically, not all of them, these are set up as debit spreads, meaning you'd buy and sell a call at different strike prices. If you're betting on the fact that this stock price is going to move up, like Nvidia here. And why do we do this? Well, because of this, the options play becomes cheaper because you will get credited the money you get for the selling this call option at a strike price above current price. So you can offset the price of an outright call, for example, that way. So what you can see also here is how much it would cost you to set up this play. Of course, this one is a bit more expensive, but which is reasonable for an expiration this far out. What is your maximum gain, and what is your risk on this play? And you can see it for every single alert that this is all detailed for you to follow suit if you like this setup as well. And lastly, we are rounding up this newsletter with our forecast. What might transpire in the next week? What are events to look forward to? Are there earnings coming out? Are there some other fundamental news coming out and so forth? And this is all summarized here. And this, once again, is not just for options alerts, but for the market as a whole. Also including international plays. What are the commodities doing? What are the metals doing? What is crypto doing? And so forth. And Jim, would you like to expand a little bit on this?
Well, I tell you, there's a lot of information there of which you can take advantage of. In this review of the markets, I identified some coincident information. Many of you might not realize it, but there's been a little bit of a connection between the full moons and substantial volatility. And ever since December, I mean, it's just been fantastic as far as how much volatility has come right around the time frame of the full moon. So I put that into my analysis because, I mean, if you show me that on December 15th, after that, the market drops 300 S&P points, or on January 13th, there's another 300 points, or February 12th, we're at 6,100 and it goes all the way down to 4,800. These are time frames of volatility that I'm going to have to say that are something to put into your analysis. The other thing is like on the international markets, I give you the symbols from the different ones. Germany's been going nuts, but I've told people about that since January, and the international markets of emerging markets. There's a lot of opportunities there, and I discuss them each and every week. And of course, on the gold and silver, we give you updates on that. Silver's getting very interesting now. A move above $34 an ounce could mean a very big breakout on that, and nobody's talking about it. But I follow these things very closely, and you'll have good information as far as well thought out on what's going on here, because it's not illegal to take information out of the back here and go, oh, he likes the idea that Europe might be going up. EUFN is all the European banks. Let's take a look at the European banks. Well, you know what that thing's gone from? $21 to $32. Not bad. So you might not even know that. So this is, use the entire report. In the beginning, I give you what's going on currently and what I think is happening. Then I give you ideas. Those ideas, you got to be, using your brain as far as, not putting too many on, not doing too much, talking to your brokerage firm and making sure what you're doing is appropriate. These, and maybe you will do, if the market's obviously going up, maybe you put on the call first and then put on the put, as insurance when you think you might need it. So there's things you can do, these are ideas that, you can adjust, but, a lot of the ideas, do get volatility. And once the volatility hits, like I say, during the coaching session, I can explain a little bit about how to move after you're in there.
Yeah.
which is a big part of what we have. And you can see we've had tremendous volatility. These are all of the ones we just showed you. We had Boeing call options on that for $400, and then Boeing went to 209. The calls alone were $3,900. If you do a combination, you'll probably not make money on both sides. So that's okay as long as one side moves enough to make it profitable. That's the idea here. Sometimes you're surprised and it goes way, way down and you'll make money on the put, even though you didn't think you would. But again, you have both sides on so that volatility goes up or down dramatically. Then you can make some pretty good money. But again, I like to just do small, do small trading and let the markets make it big, and then try to pick sectors. I don't think we mentioned the fact that we break down the ideas by sector. So if you see, the banks are doing good because deregulation is coming or something, that might be something to keep an eye on. Or Trade Desk is into software. If you see tech and software is doing good, maybe that's why you take a chance on Trade Desk, because you look at the chart and you can see it's low. So again, these are ideas. They're not recommendations because you have to make your own decisions on them. But the information is there for you to work with, and that's a key. And if there's questions, again, you get my cell phone that you can text me, and then we can always have a conversation. So that's really the key. You get the information. If anything is confusing or you would like my opinion on things, you just text me. And of course, we can talk and cut through everything and make it simple for you, because, it is overwhelming to some people because there's a lot going on. But again, at the end of the day, it's not that complicated. You're looking to buy options that are cheap, where volatility is going to come in and make those premiums expand. And when they expand, that's when you're going to try to get out.
Yeah, exactly. And yeah, we basically have two options to take advantage of this alert service. And of course, no pun on word when I say options. So we have a quarterly plan where you can first off get $100 off the first quarter and receive then our option alerts every single week, every single Sunday, like clockwork, in your inbox for a full quarter. And this includes two other things, I think, where really the rubber hits the road. So you get the report, but you will also get our 6-hour options masterclass, which we have recorded over 3 long sessions where we detail all the different strategies that we're covering in our reports. You will learn options from the ground up. So if you never traded options, this masterclass is for you. But if you're already quite experienced in options, we will explain things in this masterclass, which will help you fully understand what's going on in our alert service and how to take full advantage of it. But there's more. You will also get 1 hour of one-on-one personal coaching with Jim, the option professor. You will get his phone number. You can text him. You can set up an appointment at your convenience. And then you have your coaching session, which can also be split over perhaps 2 or 3 if you want to stretch it out. So this all comes with the quarterly option. But we have one more. We also have a yearly plan, which will give you the best value for your money. For $897, also discounted by $100, you will get, of course, the 6-hour masterclass, but you will get 4 hours of personal one-on-one coaching. And if you want to make a commitment to options trading, I believe the longer term play is the better one, because then you have more time on the clock, just like for an option expiration. More time on the clock, you will get more alerts. You allow yourself more time to learn trading options and taking advantage of these options alerts. And I'm going to put this link, tradingindicators.com/alerts, into the chat box. This is where you can take advantage of these 2 alert services. And while I'm doing this, Jim, please expand a little bit more on this, and then we're going to get to questions afterwards as well.
Well, frankly, I think there's 2 choices here, and I think the annual one is the best one to go with. If you are going to try to be serious about options, you're going to get a full year of the alerts every weekend. You're going to get 4 times the coaching, where if you have questions, you call me up and you go, Jim, I'd like to talk to you at 4 o'clock Eastern time. And then I go, okay. Or we get an exact time that's good for us, and then we go through whichever on your mind. Or maybe you get the alert and you go, Jim, I was wondering if there were a few sectors that in your opinion was the ones you'd focus on now. Of course, we can have that kind of conversation. So I can help cut through any confusion you have on the alerts or any question you have on the alerts. And also I can help you with some of your strategies as far as, after you're in there, how do you come out of these things? What's the best way to try to let them run, but not give your profit away? And how much time do you give these things? All those questions, I can help you with my opinions on those. And again, the annual gives you 4 times the amount for, obviously not 4 times the money. But if you want to just try it out, again, a lot of people try it out. And here's the good deal of trying it out. If after a month you like what you see, we can take a portion of what your first quarter was spent and apply it to the annual. So again, just using round numbers, if you did the quarterly and after 1 month you wanted to convert to annual, you could. So if you're, maybe you've tried other people and you're not happy with them or whatever your issue is, and you have to just do the quarterly, that's something you could do. But if you're really going to be into options, and you want to really be smart over a long period of time, and you want to put some money into your education, as well as getting ideas and having access to somebody who's done it for decades, the 897 is kind of a no-brainer, especially when you compare it to what the money you have at risk in the market and the amount of information that has to be, shall we say, dissected. You have somebody who's dissecting it for you. And then, of course, like I say, you'll have a coach who can explain a lot of the minutia of options to shorten that learning curve, because learning curve can also cost you a lot of money. And so hopefully the coaching could shorten the learning curve, which obviously would save you more than the 897 on the annual, that kind of thing.
Yeah.
So and one last thing for tonight, because a lot of you guys have been here for the entire time. For those of you who've stayed here, I'd like to give an extra 2 hours of coaching on the annual and 1 hour of coaching on the quarterly if you do sign up tonight. So you get an extra bonus for making a decision tonight. And again, we've got a lot of stuff right ahead of us. That pause on the tariffs is coming up on July 9th. We've got Fed meetings coming up, CPI numbers coming up. So I think there's going to be a lot of interesting stuff. And we just had a huge rally. That huge rally is either going to continue or it's going to take a pause if the Senate starts hacking up that budget. So there could be a lot of good excitement ahead. So I'm encouraging people to get started by giving some extra bonus by starting tonight.
Oh, that's very generous. Thanks, Jim. Awesome. Okay, let's address a couple of questions now. And actually, I want to read out one comment by Frank, which is a great segue to what you just said. He said he preferred to learn how to fish rather than be given the fish. And I think this is exactly where our options masterclass comes in, but also our personal coaching. Because as Jim just said, if you want to cut the learning curve, I think the one-on-one coaching is what you need to do. And of course, getting a couple of trade ideas at the same time doesn't hurt either.
Yeah, no, that's a great question, by the way, and maybe more people should ask it. In other words, I really want to be my own Buddha, and so that's good. That's good, but you're going to need the knowledge to do it. And what you do to during our coaching is, Jim, here's what I'd like to accomplish. How can you help me accomplish that? Or here are stocks that I like, and here are some strategies I was thinking about. How would you approach them? And that's where we can really help you, again, with that learning curve and hopefully bring your expertise up. Because one thing about options, it's kind of like a basketball game. There is a lot of different options out there, and sometimes you don't have all day to make your decision. And maybe you don't know what all the options are. And so that's why my experience and knowledge, I think, is quite helpful, because I can give you the menu of your choices out there. And the more you know about your choices, I think the odds are better that you might pick the right choice.
Yeah, exactly. All right, great. Anne is wondering, will there be a recording? Yes, of course. And there will be a recording. It will be posted at the same site at tradingindicators.com/alerts. So this should be ready either tonight or tomorrow morning. Sharon is wondering, for the performance numbers we've shown here, is this for one contract traded per leg? Yes, exactly, for one contract traded. That's that. Olga wants to know, what is the schedule for the masterclass? Great question, Olga. This is actually a recorded masterclass. It's already there. You will get it right away as soon as you signed up. You can start watching it. You can pause it whenever you want. You can rewatch it. It's yours forever to keep. So you get this masterclass right after you're signing up. All right. Is there a certain brokerage that is needed? No, I don't think so. You can, whatever broker supports options trading is a broker that you can use. And, you should always find the broker that is right for you after consulting with the broker, making sure that, the broker understands exactly your risk profile, your financial situation, and so forth. So, but there's no broker or specific broker that you need to follow these trade ideas. All right. Okay, let's move on. Next question. Lenny wants to know, when you price out options, do you ever look at open interest to determine a good strike price? That's a question for you, Jim.
Well, I don't want to hear an echo chamber when I go down there and make a trade. You want to have some volume. You want to have some open interest. Since mostly I'm not doing so many, like when I did it professionally, I might do 1,000 contracts, right? Then I need to be trading in something like an S&P index where the depth of the market is quite high. If I'm only doing odd lotters, then it's not necessary. But the more volume you have and the more open interest, the tighter the bid offers are. So that it is a factor, but it won't be the total factor. You know what the biggest factor is? Where do I think that underlying's going? Over what period of time? And what is the actual option prices? And am I going to be able to make a big hit? And I'll tell you how I figure that out. I say to myself, okay, if I was the seller, what am I getting? For instance, some of those ones you saw. Do you think I would sell unlimited risk options for $200 or $300 going out 2 months on a stock that's in a tight window that has earnings coming out? I mean, talk about risky. And of course, when you do something silly like that, you generally lose a lot of money. And that's where I think that the buyer is going to make money. So what I kind of do is my philosophy is pretty simple in that I'm going around looking for options on stocks that I think the seller is absolutely going to get creamed. And that's when I think we got a good buy. If I don't think he's going to get creamed, then it's a no sale. So, I use my experience to go, okay, looking at this setup on the stock, okay, looking at the strike prices, looking at how much the options cost, who's getting the better deal here? Who's really taking huge risk? And if I think the seller is taking in ridiculously low premium for something that volatility could explode at any point, then that's the one that's going to hit the list. And that doesn't always work, but when it does work, it works big, and it works, quite often. So that's the way I operate. I'm looking for where the seller, I think, is making a big mistake.
Perfect. Another question from Sharon. What delta do you use when you look at the options chain, or do you consider the delta value at all, the Greeks?
I just look at this screen and I look at the options and I look at the charts and I look at the time frame, and then I look at how the options might react if I get movement. And I basically do it that way. So I would say I don't use the Greeks like many people would, or at least I don't use them in a conventional sense. I use basically what are these things priced at? What are the ones that are out of the money going for? In the money going for. So if my option goes from out of the money in the money, what kind of expansion can I get? What's the news coming up on this thing? We got any news either from the government or the Fed or earnings, or is there a convention or something that's going to move this thing? And so I use a combination strategy to come up with the ideas. And as far as the deltas and all that kind of stuff, I kind of eyeball it on where the options are priced under closer to the money than the ones I'm doing, to give me an idea of what kind of spring I'm going to get if I'm right. Because if there's no spring, meaning if the options are all priced at about the same amount, I generally shy away from that. I like to see where my options are going for $1 or $2, and the ones underneath are going for 3, 4, 5, and 7. Because then I get an idea of, if I'm right on this and volatility picks up, I'm going to get paid.
Great. Awesome. Lorenzo wants to know, what are the top sites that you subscribe to? You mentioned at the very beginning that you listen to everything like Bloomberg and Fast Money and so forth. Do you have any specific subscription that you follow?
Not really. Nope. Because I believe in taking in all the information and then making in other words, I take in information, but there's information that hits me and I go, wow, you know what? I think that's important. Um, like for instance, uh, well, like the big move up in Nvidia today, and then I noticed on the earnings the other day that the margins went down to 60% from 70 something, and they dismissed it because of the charge off on China. And I said, you know what? When you're priced, when your stock has gone up 60, 70% in the last month or two, anything that doesn't look right in your earnings, I'm going to think is a problem. And so the bottom line is that would be an example of how I'm listening to everything, right? But then I heard one thing that I thought was kind of important. And obviously, margin compression is not a good thing when you are supposed to be the hottest thing in town.
Yeah. Gerd wants to know from Germany, he didn't have time yet to watch the masterclass, and he also didn't have time to book the appointment for the coaching. Is there a limited time on the clock up until when you can take advantage of it? And no, there actually is none. The masterclass is yours to keep forever. Watch it at your leisure whenever you want. And also the coaching, whatever you have in the bank stays in the bank. There's no expiration on that. All right, that was that one. Frank wants to know, in your coaching, would you also assist on 0-day expiration options?
I can zero in on, and that's that people don't understand this, and even subscribers, should understand this. I'm familiar with all types of trading. So if your interests are in a certain level, like day trading, short-term trading, I mean, maybe some of you people are out there and they're trying to get approved in the prop trading. I would have a way that I would do that if in fact I was interested in that. So if you're interested in the shorter term, and I gave you a couple of examples on short-term trading, I think things that expire next Friday are pretty darn close, right? So I know how to work with that type of stuff. So whatever type of trading you're interested in, let's talk about it in the coaching session, and let's try to help you do that type of trading the best you can.
Perfect. Thanks, Jim. Yeah, and as a reminder, if you sign up tonight, so thanks for those who already signed up, you will get extra coaching hours if you sign up tonight as an extra bonus for staying on so long. We are now 1 hour and 30 minutes into this session, so as an extra bonus.
I told you,
you.
time flies when you're having fun.
That's right. Perfect. All right, guys. So let's move on. So this is the offer that we have today. I think it's a really interesting and generous one. And if there are any questions which were not covered, I think we went through most of them. You can always reach out to us and to the option professor at professor@tradingindicators.com. Simply drop him a note. He'll be happy to answer all your questions. And if you have any general questions about what we do here at Trading Indicators, you can also reach out to us via our homepage at tradingindicators.com. Go to the main menu, click on contact, put your question into the contact form, and it will get straight to my inbox. And I will also make sure to answer every single question. With this, guys, I thank you so much for staying on so long tonight. Think about the offer that we have presented to you at tradingindicators.com/alerts. It's valid until midnight Eastern time tonight, so don't wait too long. And with this, guys, I wish you all a nice evening or a good morning wherever you are. Thank you, Jim, for your insightful presentation, and hopefully see you on board soon.